So again, welcome to today's NYSEIA webinar on understanding the property tax exemption for solar in New York. If you guys are just getting on, I'm Melissa Kemp from the NYSEIA board, and I'll be leading today's event. As I mentioned just a few minutes ago, a couple housekeeping items. Please let me know if for any reason you can't hear well. You can also send questions in via the webinar interface at any time. We'll try to answer them in the flow of the webinar. And then we'll also do questions in an audio way at the end of the presentation. Also, if you're calling in by phone, please make sure your line is muted, and everyone in the GoToWebinar interface should be muted automatically. Great, so getting started, this is the webinar about the property tax exemption for solar. We're talking a lot about the extension of this policy through 2024, the coming valuation of solar, and the rising importance of this issue in New York. So just about us really quickly, this presentation is being given by NYSEIA. A lot of you are members, so you're very familiar. We're a statewide trade association dedicated solely to advancing policy and deployment of solar energy. There's a lot of really innovative things happening with NYSEIA currently, so it's exciting to be a part of it, and this is the first of our new webinar series, which we're planning to focus on cutting-edge policy issues of importance in New York. Presenter for this event is myself. I'm Melissa Kemp. I'm a renewable energy professional who's been involved doing solar work for the last 10 years, a lot of sales, engineering, project management, and business development experience. And I'm currently the program director for Solar Tompkins. We're one of the largest solarized programs in the state, and we're trying out an innovative way to deploy and increase the rate of deployment of solar PV in Tompkins County, New York, which is where Ithaca is based. I'm also obviously on the board of NYSEIA. So just some background. So the obvious, renewable energy development is bringing huge economic, health, and societal benefits to New York. It's a really exciting time. We're up to almost 300 megawatts of solar PV that's been installed in the state. And the rate of solar deployment in New York continues to grow. And as this happens, there are several policies that are really becoming much more important than they have been to date. And one of those is how these systems are being treated under property tax law. So I want to do a little introduction here to property taxes in New York and what that means and how they work, and then actually go into the policies nationally very quickly and then focus on New York. So property tax is a local tax here in New York State. It's raised to finance local governments and school districts. You guys who are used to paying it, you pay it to your local town, city, or village, also to the county and also to the school district. And it's based on the value of one's real property. So real property is property that you own that's attached to your land, to your home, or to your business. The other type of property is defined as personal property, and that's property that's not attached, that you could easily take with you. So those are the two main classifications of property. In New York, to date, solar PV systems have been categorized as real property. This is being debated in other states, and there is a case to be made that it should not be. But today, up until this point, and all of the legislation we have categorizes solar PV systems as real property in New York, so we're going to start from that point. So property taxes in New York, as I mentioned, are paid to your local jurisdictions, and they're calculated as dollars per thousand. So you owe X dollars per thousand of the real property's assessed value. Different places do the assessments differently, but regardless of where you are, the taxes are dollars per thousand of assessed value. And in New York, real property taxes is very generally, typically total, between $20 and $60 per thousand of assessed value. New York City and downstate is a different creature, and so it can be quite a bit different than that. But generally statewide, that's a pretty solid range. So what kind of property tax policies are there out there for solar, just generally, stepping back for a second, nationwide? We've got property tax exemption policies. So that is when the value of an addition to your real property is assessed in value. It's counted as having value, but you are exempt from taxes on that additional value for a given period of time. And that's what we've got here in New York State. We have a property tax exemption that I'll talk quite a bit about in a moment. Another type of common policy is property tax exclusion. You'll find that is the common policy in California. And that's where the value of a specific addition to your real property is actually not included in the assessed value. And therefore, because it's not included in the assessed value, it's also not taxed. Obviously in California, their appraisal folks do things differently, but on the assessor side, this is how they do it. And then the third type of policy, which a lot of you from downstate and from the city are really familiar with, are property tax abatements. And those are used for a lot of other types of development as well. And that is just a reduction in the general amount of property taxes that you owe based on usually a percentage of the total system value. So in New York City still, I know there's a work to extend this past 2014, but it's 2.5% a year property tax abatement, so 2.5% of the total project value for 4 years. And that's just something that comes off your basic property taxes that you typically owe. So those are the three types of incentives that are very common. These policies exist in over 35 states at the current time, all to encourage the development of renewable energy. And in many leading states such as California, Arizona, New Jersey, and Massachusetts, all residential and commercial solar systems that produce electricity are generally exempt. Those states are very different. Some have very simple blanket policies. Most of them have simpler policies than New York. And in some states, they're just currently still discussing exactly how to interpret these policies. But all of those states have very good policies that are even more blanket than ours. Also in California, they go as far to also exempt utility scale systems from property tax as well. So with a little context there, let's just go into talking about our property tax exemption in New York State. So our property tax exemption in New York is for solar, wind systems, and actually farm energy systems or farm waste energy systems as well. It's section 487 of the New York State Real Property Tax Law, and that's a link to that. We'll share these slides after this presentation, and that would take you straight to that piece of statute. So this has been an important policy in New York. It's been around since 1977, and it was just extended in June of this year by the New York State Legislature. It was extended for another decade. So it was set to expire at the end of 2014, and it was just extended for another 10 years through the end of 2024. That bill went to Cuomo's desk, I think just this week or last week, and was signed into law. So that's what's happened really recently. And our policy generally it's similar to other leading states, except that it has an option, which was just added in 1990, that allows local jurisdictions to opt out of providing the exemption, which is a really important difference that we're going to focus a lot on in this webinar. So more detail on our property tax exemption law in New York, which is section 487. So it does, as I said, apply to solar, wind, farm waste energy systems. The way it works is it provides, at this time, a 15-year exemption on property taxes, starting when a system is completed. The default is that all jurisdictions are opted in to providing this property tax exemption, and that if they wish not to do so, they actively have to pass a local law or resolution to do otherwise. All jurisdictions that are opted in and providing the exemption are still allowed to do payment in lieu of taxes, or pilots as they're commonly called, for certain systems. So just because you're providing the exemption doesn't mean that you still can't negotiate pilots for certain systems. And I'll talk more about that in a second. It's subdivision 9 of section 487 that has this piece to it, and it's a really important detail. So pilots, what are they in this case? So subdivision 9 says that any jurisdiction providing generally the property tax exemption from solar can still do a pilot. And what that's typically meaning is there is no specific requirement for when a jurisdiction should do that, but how it's been interpreted is that when projects get to a certain size or a certain nature, then a pilot is negotiated. And so far, that size or that cutoff point that triggers a pilot has been typically somewhere around 3 megawatts or larger. And to date, most of these projects have been wind projects. There may be some solar pilots negotiated that I haven't yet heard about, but generally all of the data so far in New York has been for the negotiation of pilots for wind projects. Pilots that have been negotiated to date across New York have typically been $8,000 to $9,000 a megawatt has been the payment negotiated, and that's an annual payment. So the developer pays that amount per year to the local jurisdictions. And the $8,000 to $9,000 per megawatt is megawatt of nameplate capacity, which is calculated typically differently for wind and solar. But solar could be, STC rating on the DC side or AC rating of a system. And there is a lot of state data that shows that jurisdictions that do pilots when they remain opted in, providing the exemption for everyone else. So they're providing exemptions for residential and commercial wind and solar, but they're going to do pilots for things over a certain size. Those folks have had just as good a time and even sometimes better time collecting a really good pilot than folks who had opted out of providing the exemption to anyone at all. So pilots are typically negotiated with the developer by the local governments, often under the lead of their local IDA or Industrial Development Authority. And IDAs are a weird type of corporation. They're a public benefit corporation authorized by the state. Some of you, I'm sure, are very, very familiar with them, and so they're focused on economic development. And under the updated version of this law, the way that this is supposed to work is that for larger facilities that might be required to have a pilot, when the developer is planning to construct them, when they get to what is defined as the start of construction, which they say is the execution of an interconnection agreement with the utility, they are required to notify the taxing jurisdictions in which they are located. And then the taxing jurisdictions have 60 days to let the developer know whether they have any intent to require a pilot. This is the way it currently is set up in the law now. I'm going to talk about shortly how we can make this better. Obviously, this is better than no notice, but there's still a lot more that's needed to make this actually functional for developers. So the current state of the exemption in New York State, so right now about 92% of the jurisdictions continue to offer the exemption. Note, though, that currently a lot of them, for example, here in Tompkins County, there's no potential lost revenue stream from this exemption at the current time because assessment offices have not yet started adding additional value to properties for solar. And I'm going to talk a lot more about this, but just keep that in mind. So we've got 92% still offering. We have about 175 out of the jurisdictions, about 8% that have opted out already. And there's a list of these that is pretty regularly updated on the one of the state websites. There's a link to it here again when we share the presentation. If you haven't been there before, it's a link straight to it. So because the assessment offices haven't started adding value for solar yet, right now people aren't experiencing a big difference being in a jurisdiction that is providing this exemption versus one that is not. But this is going to change, and there's a growing national consensus that solar, this is led by people like Fannie Mae and Sandia, Lawrence Livermore Appraisal Institute, that solar does add value to buildings and properties, and they have a standard methodology for calculating that. And so this is going to be something that's going to be changing, and there's going to be much more of a difference going forward between places that offer this exemption and those who don't. Whereas right now, people often don't know much about it and don't even know that there is a difference. That is something that we're going to see changing as the value of solar begins to actually show itself. One other point to make is that right now, even current policies before we start adding a value for solar, those are important because the property tax exemption actually what applies to you when you construct a system. Say you're a residential homeowner, you put in a system this year, what matters is the jurisdiction's policies that you're located in this year. So for example, if a jurisdiction was opted in right now and they didn't think it mattered because there's no value being added for solar anyway, it actually does matter. It's the policy in place when your system is completed that actually determines the tax exemption eligibility of your project. And so it's something that our policy today, even before the valuation change, is going to have a dramatic effect on how these systems are treated in the future. So why does this all matter? So there's obviously, and I'm going to talk about it, really strong evidence that solar adds value to properties. Jurisdictions are beginning to understand that. They're beginning to understand that there's a consensus out there about how to go about that. And we're going to start to see a difference between jurisdictions with exemptions for solar projects and those without. And it's going to become a much, much more important thing. Right now, without having that value being added in most places, without having a revenue stream being generated, this has been something that's kind of just been put on the back burner or not paid attention to by a lot of folks. Second thing is that a number of jurisdictions that have been opting out of providing this exemption has been growing, mainly along with commercial wind development in New York. For example, here in Tompkins County, our county, one of our school districts, and one of our towns all opted out of providing the exemption back in 2012 in response to concern about a wind farm being booted up in the county. And They opted out without really understanding the consequences and also not even understanding that they didn't have to opt out to do a pilot, which is what they ended up doing. And so we're seeing this being brought up to date by commercial wind, and I'm sure solar is also going to be in the mix very, very soon. So property taxes on solar systems, if this policy was not in place, they would have a very significant negative economic and psychological impact on people, residential and commercial, and discourage the adoption of renewable energy. For example, in the resi sector, in the residential sector, here in Tompkins County, when we've done this very large community-wide program, we're going to be putting in, 2 to 3 megawatts of solar in the next 12 months. At every single one of our almost 40 events this summer, people ask about the property tax on solar question. They were concerned about it. It's a psychological and an economic barrier. In terms of economics, for a monthly solar loan or lease, for example, in the residential space, what happens is when you add that extra cost, they flip the economics. So instead of often in our area, which doesn't even have super high electric rates, often a residential monthly payment is the same or less at a decent solar site than what they're paying the electric utility today. When you add in the property taxes that would be assessed on that system, it flips the economics completely the other way, so that folks are paying more, and not just $1 or $2 more, but often quite a bit more. And so all of this is why this matters, is that to encourage rapid solar development, we really, really need supportive, clear, and uniform policies. That is what is going to make this ramp up possible and make the rapid deployment of solar possible. So what kind of solutions do we have? So immediate solutions would be getting in touch with your local, your county, municipal and school district folks, and actually educating them a bit about this issue. As I mentioned, we've seen, here in this county and in others, folks, this is not a trivial issue. People don't know much about it, and people often just kind of respond without, having all the facts or even just truly understanding the implications. I think it's also really important and positive to mention all of the economic benefits of supporting solar development, which when we've seen, when we've crunched numbers on it, that they actually make up for often any lost revenue from property tax exemption, often exceed that. So when I say economic benefits of supporting solar, I mean increased property taxes from, from growing businesses, from companies hiring more people, coming to the area, buying homes. You obviously, from a county perspective, also have increased sales taxes and other things. So there's a lot of economic development that's going to come from this kind of solar ramp up that would more than offset the property taxes that you wouldn't be collecting. And then secondly, working with your jurisdictions after you're communicating with them about staying in and providing the exemption. And if folks have opted out, working with them to opt back in. It's opting out is not a fatal, permanent thing. You can always opt back in. As I mentioned, here in Tompkins County, we had a couple jurisdictions opt out. The county opted back in July after exactly this, after several meetings and communications and figuring out that there was a better way to do all of this. And we're now currently working with one of the school districts to do the same thing. So people can definitely opt back in, and it's really a big deal. And then we definitely have step-by-step examples of how this has been done successfully here and in other places, if that's helpful to folks. So other immediate things that are really important, one would be getting jurisdictions to provide the exemption, to provide guidance on what size and nature of system triggers a pilot. So right now in most counties, and definitely for the wind systems, it's just been done on a case-by-case basis, but it would be really helpful to have a policy that says everything over this system size or everything over the system size and non-intended for on-site use, whatever the rules would be, but some kind of policy so that developers of these projects know what to expect, and so that it's a very stable and clear marketplace. Last immediate thing that would be really valuable would be to get clarification on the treatment of leases and PPAs. So when you're not actually having where the system is located, where the owner of that property is not necessarily owning the system or is not owning the system, as the case with leases and PPAs, who is responsible on the larger projects for pilots? Who's responsible for that payment? Is it the owner of the equipment, the owner of the land, or the off-taker of the electricity? And so I think there's definitely some sense of that already, but I think some clarification in that area would be really, really helpful. and again, provide certainty and clarity to developers. So medium-term things that we can do, solutions, and this I'm just speaking, in my own personal opinion, my views, not any formal NYSEIA positions on these issues. But medium-term would be to simplify and streamline this important policy by eliminating the opt-in, opt-out option completely, like other leading states. So far the states that I've looked at, and these are the leading ones, your California, Massachusetts, New Jersey, Arizona. None of those folks have a local opt-in, opt-out. And so it would make everything much simpler, much more uniform, and save us a lot of headache if we just didn't have that as an option. The other thing that might be very helpful medium term is to extend the term of the exemption. So right now, as I said, it's 15 years. For the commercial residential stuff, it's 15 years from the date of completion, but your minimum system life and warranty period is 25 years. And so it doesn't really make a lot of sense. Why not just do the entire minimum life of the system at the very least? And that's what a lot of other jurisdictions have done. California has no time limit on it. You're just, exempt, effectively exempt, period. And then like Massachusetts has 20 years, but something longer than 15 would be more in keeping with the life of the system. So any questions? If you have any questions on that, please feel free to type them in. I want to connect this all now, that all of this talk about property taxes and property tax exemption over to the coming valuation of solar, which is kind of the second half of this webinar. So the first slide on that is about why solar adds value. So just stepping back from some of the policy detail or technical stuff, solar just philosophically adds value to homes because in modern America, homes and commercial buildings, energy is a fundamental part of operating one. You do not really have a choice anymore whether to have energy services or not. All buildings have energy services. And so the cost of energy is inherent to owning a building, a home or a business or a commercial entity. Because of that, if you have a system, and solar is just one example, other renewable energy and energy efficiency systems would qualify or be thought of in this way as well. If you have a solar system which eliminates part or all of your annual electricity usage costs from the utility, if that is the case, then it's providing a value to you because you would have had to pay those costs if you did not have it. And so therefore, the value of those savings should be taken into account in the upfront value of the home or business or property. And so that is the basic kind of underpinning for all of this about why this adds value. It adds value because energy is an inherent part and cost of owning a building in modern America. And so you pay it one way or the other. If you don't have to pay it over time or you have to pay less over time, that's worth something upfront when you purchase that home or building. And so this same basic reasoning is already present. It's actually much more widespread than I think us in the solar industry have realized. This has already been endorsed in the Fannie Mae Uniform Residential Appraisal Form, which is Form 1004, which is used universally for home appraisals. And in that form, they say this exact thing. Energy efficiency and renewable energy improvements or systems add value to home because you're reducing the energy cost of operating that home or building. And there's two mandatory sections for appraisals when they fill out Form 1004 that actually ask them to add and adjust the value of things based on having those systems in place. And they clearly state that it adds value upfront to the property. And so then the question obviously that comes from that is, okay, great. I'm glad that this has like a philosophical and fundamental underpinning, but how do we actually value these systems? So how is this value calculated? So one group of folks that's been very involved in this, so Fannie Mae does recommend a couple different techniques, and the Appraisal Institute is a global trade organization and professional association for appraisers that took it from there and said, here, let us work this out for you and show you how you would get a valuation for a system or systems. And they actually created a form just for that purpose. So their form does not replace the Fannie Mae form. It's a form just to come up with the value to put in the Fannie Mae form. And it's Form 82004. There's a residential form. There's also a commercial form. And it's a form made by appraisers for appraisers to calculate the value of these systems. And the form calculates valuation based on the energy savings that these systems provide on an annual basis. And what they use is what is called here an income capitalization approach, specifically a discounted cash flow analysis. Now, a discounted cash flow analysis, for people who are not familiar, it's just basically your energy savings in year one and then worked out over time for the minimum life of the system, which for solar is likely to be, the 25-year minimum warranty period. And so you take energy savings in year one and you derate the value of that every year over time till you get out to year 25. And so that's the time value of money concept, that money is worth less to us in the future than it's worth now. And so there's a derate or derate factor that's applied to those savings each year. They go down. There's often sometimes a small bump in there for increased avoided cost. As utility rates go up a little bit, the folks would have saved more money. So there can be a little factor for that in there. But basically it's that you work it out over the 25-year minimum life and you sum up all of those savings that are discounted over time, and the summation of those is the valuation of the system. And as a system ages, you count up fewer years. So a system that is older is worth less because there's fewer future years of savings than a newer system. And so that's the metric, that's the methodology. And Sandia National Lab, which is known for its nuclear weapon complex work, not for its renewable energy work particularly, but they have a lot of a large economic staff there, a lot of economists. And so they got very excited about this and involved, and they came up with a standard calculation tool to do this discounted cash flow analysis, and that's the PV value tool. So there's a website linked to that as well, but you do not need that tool to do a discounted cash flow analysis. It just makes it very simple and easy, and is intended for appraisers and other folks to just not have to come up with the math themselves, but to be able to plug into a simple interface. So Sandia's rationale for this income capitalization approach versus comps, so versus just comparing homes, which is often what appraisers do, was that there's just a lack of data in a lot of places. There aren't a lot of homes still in terms of percentage-wise that have solar, and there's not many of them that have sold. And then the MLS system, the multiple listing service, doesn't often even have any way to search for them or to identify them. There isn't really much, that infrastructure is still being developed. And so they just felt like doing a comp approach only, where you have to find other similar homes with solar and then you derive the value added by the solar from there, that was very unrealistic, at least in a lot of markets initially. And that is why they recommended the income capitalization approach, which is the discounted cash flow analysis, as being a really good alternative metric, particularly where there's not enough market data or it's not accessible to be able to do comps or comparables. And here's just their statement about the income approach itself, which is what I just explained. But the value of the property is equal to the capitalized value of the net income stream. So that's the discounted cash flow analysis. Your income is your energy savings. The valuation of that property is based on the sum of those energy savings over a minimum period of time or life expectancy. And that is discounted based on the time value of money. So what would be an example of this valuation? So just for illustrative purposes, and I picked something really simple. I've been enmeshed in this community-wide solarized program, so I just picked an example from the resi side, but you could easily do a nice commercial example as well. But the assumptions in this model, so there's the discount rate, so that's the time value of money. So it's somewhere between 7 and 10% a year, meaning the value of your money, the value of your future energy savings is 7 to 10% less each year. The time span for solar, I've commonly seen it as 25 years, which is the minimum warranty period. And then there's the current avoided electric cost. Here in this area, 12 cents for the resi market is pretty common. But obviously downstate, you'd have a higher cost for that. And then there's the potential escalation of future electricity prices that you're avoiding from the utility, which should be conservative, or 0 to 0.5% a year. And so what all this shows, sketches out to be is that the total price, for example, in this resi example in a community program currently in New York, you can get a 7 kilowatt system. The total price, the sticker price, is $24,500, for example, in our program here in Tompkins County. The final cost of that same system after all of the incentives is $62.16. And so those are the two price points that a customer sees, that a homeowner sees in this example. The valuation of the same system using the discounted cash flow analysis recommended by the Appraisal Institute and Sandia and others, it comes out to be valuing the system at $9,000 to $12,000. And the range is depending on which assumptions on this page right here you use, whether you pick the 7 or 10%, what your exact rate of utility escalation is. And so you're $9,000 to $12,000, and so that's the added value that would be in New York assessed, or the added assessment value put on the home. And if you're in a jurisdiction that still is opted in, providing the exemption, your assessment would go up, but you would not pay taxes on that additional assessment. So let's just pick the $9,000. You put in a 7-kilowatt solar system on your home roof. Your assessment should go up $9,000, but you should not pay any taxes on that $9,000. And so you'd basically have the portion of your assessment, the bulk of it, where you paid taxes on it, and then you'd have the $9,000 pulled out and noted that this was tax exempt for 15 years at the current time. So that's kind of how this works. When you take this example using these recommended methodologies and you compare it to other studies, it comes out really well. So in our example here, the cost per watt, so the valuation of the PV array, if we go back, this $9,000 or $12,000, when divided by the system size, it comes out to be $1.30 to $1.70 per watt of capacity. So that's what the value that the assessor or appraiser would add to your property. And this range is consistent with a large number of studies and with a large amount of data. There's been, I think, 6 studies done in California, 1 in Colorado. There's also 1 in Texas that we haven't had a chance to look at closely yet. But it came out to be very, very similar to what is found in all of those studies, which is those studies are based on real-world, large-scale data. And this range is also consistent with the large body of data about the price premium or the added value for weatherization, other home energy efficiency improvements in the US and Europe. So when you take not just like similar, but pretty darn close numerically. So you can make everything in cost per BTU or cost per watt, but they come out to be very similar to this 130 to 170 a watt range. So what that, in our experience, provides is some validation to this model, that in areas where we have enough data to actually look at what's happening in the market and compare it to what the discounted cash flow analysis methodology tells us it should be worth, those things are generally truing up very well, which is encouraging and means that the discounted cash flow analysis seems to be gaining incredible validity as a way to approach this valuation question. And so in terms of the future, so assessment offices are tracking these systems now. Many will soon be adopting these kind of standard practices for how to add value for solar to homes. And this is going to be becoming more and more common as more homes are sold with solar. So this year alone, many counties are doubling the amount of solar that they have put in. And if that trend continues, we're going to have a lot more solar, and this is going to be starting to be taken into account. In addition, once we have a large enough number of systems, we can do our own studies using statistical methods known as hedonic analysis, where we can extract that added value for solar in the comp methods, as well as using the discounted cash flow analysis, and make sure that the two are truing up like we've seen from data across many other states. And so I think the takeaway from all of this, I hope that this has helped to explain a little bit of the importance of property tax exemption and the changing field in terms of the value of solar, that as this value of solar is kicking in, property taxes and the issue of if systems are exempt and where, and making sure that that's the case, all of this becomes a much bigger deal. And so all of this will be positive for reselling homes with solar, for building new homes with solar, but it's really going to bring this question of property taxes on solar to the forefront. And if we're trying to keep unnecessary obstacles and barriers to people going solar down, not having to deal with property taxes is a really, really important part of that. And one that I would, very much encourage you to focus on now and see if we can solve this issue so that we can reduce, continue to reduce the number of barriers and the costs of going solar, so we really can reach and exceed our deployment goals and get on track to where we need to be by 2050. So on that note, that is the bulk of the slides here I had to present. I would love to, I don't think we have any questions that have been typed into the GoToWebinar interface. Let me see. Maybe we could just, there are some questions here. They're a little hard to read for some reason. Maybe we could open up the lines, and I'd love to answer some questions if people have them just on the webinar here. Okay, so I don't hear any questions off the bat, but I can go through, I can see and answer some of these ones that have been asked if that would be helpful. So one question early on, the New York State property tax exemption is only for residential. What about doing solar on a commercial property or nonprofit? So the property tax exemption is for not just residential, it's for residential and commercial, and a nonprofit as well. There is no distinction based on that. The only distinction is whether you're providing it or not by opting in or opting out, and then how you choose to interpret, a jurisdiction chooses to interpret the pilots. Typically, as I mentioned, pilots are only negotiated, if you're providing an exemption generally, pilots are only negotiated when you get above a certain size system. So just a housekeeping question, will the slide deck be sent to participants or available for download? Absolutely. We will send out this group of slides. We also have a recording of the webinar that we're hoping to post if that's helpful. So are the existing pilots publicly available somewhere? Yes. As far as I'm aware, they're not in the database. That would be really handy and maybe something that needs to be built. But with some research, we were able to track down, over a dozen of them, and I'm sure there's more than that. So if you're interested in the details of the pilots that have been negotiated elsewhere, I would be happy to share a lot of that information with you, and we can also double check and see if anyone's begin to be collating it. As far as I know, I have not seen that yet, but it would be a very smart idea. Another question here. So just asking about the requirement where developers have to give taxing authorities or jurisdictions notice, and then they're required to let the developers know whether they intend to require a pilot. Have we seen instances of developers starting the pilot conversation earlier than what the statute requires? No, not yet. So this requirement is just part of the new law. So when they extended the property tax exemption for another decade in June of this year, they added this language about developers having to contact taxing jurisdictions, and then taxing jurisdictions having to get back to them within 60 days. So we haven't seen this play out officially yet. So I have not seen instances of developers starting the conversation earlier, but I could understand that as a need. I don't think, from a developer point of view, waiting until you have an interconnection agreement executed, it's kind of like too late to know whether you should have a number penciled in there for a pilot. So having either jurisdictions have a policy on this or having a state policy on this would be really, really helpful. Also exploring whether jurisdictions would be willing to talk to you earlier. That is another solution, I think. So another question was, in a jurisdiction like Tompkins County, which does not include the value of solar in the property assessment now, is there any assurance that future property tax assessments will continue to exclude the system? Or can the system start to generate additional property tax at any point in the future? It can do it at any point in the future. In fact, in Tompkins County, we've been working with them to include the value of the system because we see nationally and from all of this data and all these methodologies, that's where things are headed. Solar adds value. And so we're actually actively working with folks like the Tompkins County Assessment Department to add value for these systems. What we want to do is provide the exemption to protect people from the taxes on that value. But yes, they have not yet formally made that change. Here, for example, and when they do, it will just kick in, and everyone that's exempt will have no property tax impact, but if someone wasn't exempt, then they potentially would be, at least according to the letter of the law. Another question was, is there a fix for the gap between the 15-year tax exemption under 487 and the 25 years of the system life? And this person said, for example, getting the IDA to agree at year 1 to provide a pilot during the later 10 years. That's possible. I mean, obviously that wouldn't solve the problem for like residential and like small or medium-sized commercial systems, because they don't have anything to do with the IDA, or they're not really eligible for doing pilots. Personally, and I have to think about this more, but I think the solution is probably a legislative solution, just in some other piece of legislation that relates to these kind of issues, having just an adjustment from the 15-year period. My understanding, and from talking to several legislators about this, was that at the time, back in 1977, when this 15-year period was put in the law, I don't think people really knew what to expect for the life of a solar system. So it's very likely that the intent was just to cover the life of this first round of systems, at the very least. And so it may just be a technology changing, a symptom of the date of the law, where that 15 years was meant to be the life of the system, or minimum, kind of warranted practical life. And really, it's not 15 years anymore. It's definitely 25 years. But for the residential and commercial, where the exemption, we're hoping to keep the exemptions applying across the board, I think the solution really is a legislative fix, in my opinion. Then next question, I think there's just a couple more. Please clarify on the slide the comparison case studies that we wrote, that the valuation is $1.30 to $1.70 per kilowatt. Sorry, it should be per watt. Is this based on the discounted cash flow? Yes, it was based on the discounted cash flow analysis that I just showed for that example system. So it was that 7 kilowatt Resi rooftop example system that came out to be the $1.30 to $1.70 a watt. And what I had said was that matches up with all of these other studies from large amounts of real-world data in states that have a lot more solar deployed than we do. And is it the same for commercial and residential systems? I can look into that further. I think it's pretty universal, regardless of scale. But it's a good question, and we could double check that. Obviously, utility scale stuff would probably be a different creature. I'm pretty sure all of those studies were focused on the residential through like medium scale commercial markets, but I can double check. And I think that, guys, is the last question that was entered here. If anybody has anything else, please feel free to type it in now or to jump on the call and ask your question aloud. We will be sending around copies of these slides and posting this webinar. Again, if you have questions that you'd like to talk about further, I'm definitely accessible. My email address is here on the screen, and also my phone number is on the Solar Tompkins website on our contact page. You're welcome to give me a buzz or to send an email. We're really excited about kind of finding a way to improve and simplify this issue, get out ahead of it, and make sure that it doesn't have a negative influence on solar development and deployment in New York State. So I guess on that note, thank you all so much for joining this call and this webinar. It's been great to have all of you on here. I hope that it was informative and interesting, and we look forward to doing more of these webinars in the future on issues that are growing in importance, and hopefully that we can be proactive in shaping and really helping this New York market go from its 300 megawatts today to get up somewhere on the, on the scale of California and other states that are ahead of us. Great. Thank you guys so much. Appreciate it. And with that, we will wrap up the webinar. Again, please let us know if you have other questions or if we can help in any other way.